What is up, YouTube? This is the Working Investor. In this video, we're going to pick up on where we left off on risk management with the high yield dividend ETFs, because we live in a new era of high yield dividend ETFs that are option-based ETFs. And option-based ETFs, of course, a lot of us are drawn to it because it has phenomenal return, as you can see with a lot of these funds that they have out there in YieldMax and in Round Hill Defiance, RexShares, Neos. We can keep going on and on and on. And it also brings another thought to the consumers of what one can do to try to mitigate risk and how to do risk management within these funds that are option based. And I'm not a financial advisor, but I'm going to give you some of my personal opinion as a retail investor. This is not financial advice. You take your own risks. These are things that I think about and just wanted to share with you guys. So you want to think about risk versus return, because you want to make sure that you're getting a risk-adjusted return. If you're taking a certain amount of risk, you want to make sure that that risk is justified with the correct amount of return. Because if you're taking on, let's say, 2 units of risk and you're only getting 1 unit of return, that means that if the market does, go down, and if Murphy shows its face, it's not fair because you didn't get enough reward to make that risk worth it. So you need to look at, when you pit 2 funds against each other, trying to compare apples with apples, make sure that the risks that one fund takes versus what the other one takes, if they're equal, and what margin do they differ, and what's the difference in the return, and is it worth it? So you also you want to play, there's defensive and offensive. If you have a fund that returns 110% return, but you have risk of a 30% drawdown, that seems to be that the reward can outpace the risk. But if you're getting a 30% return and you have a 30% drawdown, that seems not fair. And investing in this type of fund would make it unfavorable versus other funds that sometimes can just hang out at the price that they're at and still pay out month after month 25, 30 to 35%. So you need to look at your risk. Are you getting a risk-adjusted return? Another thing is, with all these funds, you could see SPY. These are just some I pick out that I like. SPY-T, GIAX, right? But, I made some videos on this. Let's say SPY-T is if you want to compare SPY-T for GIAX, well, they're different in a way, right? They're both, here's a similarity. They're both call credit spreads. But one of them is a call credits, one is an S&P 500, obviously, and one of them is on multiple sectors. But, let's say they were both call credit spreads in the S&P 500. So they similar in, let's say you find 2 funds that are exactly identical in strategy, and they're exactly identical in the underlying that they trade, whether it's an index or a specific stock, right? Let's say, I don't know, Curve versus YieldMax, whatever. Well, they're different because they use different strike prices, right? But let's say you do find funds that are literally the same. Seriously, because every single week, if you're noticing, there are new funds popping up every single week. Let's say you have a few thousand stocks out there in the market, because for every stock, you could play it different ways with different types of option strategies. So you can have a multitude of funds that are derivatives, and you can have these derivative funds that are based on the same underlying. You could literally have 20 ETFs on the same index or the same stock, and they all have their own little twist and turn and their own little perk to it. So, but let's say, and I'm sure there's going to be a time where you're going to have 2 funds that are identical in underlying, identical, very, very close in premium percent, and very close in the the risk management, how they set up the trades. So the question is, does it matter if you have to, should you put, let's say you want to have S&P 500 exposure, and you want to have it exposed with, let's say, a covered call option, and you find 2 funds that are exactly similar. Let's say they both do weeklies, right? So it actually makes sense in my mind to split the risk up. If you find two funds that have two great fund managers, of course, if they have a not such a good track record, you want to think about if you want to continue pursuing that. But if you have, let's say, two good ETF companies and two good managers, and they both have good track records, it actually makes sense to divide your allocation up between different fund managers than have it all in one fund. Because when it comes to these actively traded funds, these actively traded funds are managed, and it's all about risk management. And you can have two brilliant and very seasoned fund managers. One fund manager will make a call to do one thing, and one fund manager will make a call to do something else if there's a change of volatility in the market, or picking their strike prices, or how to manage certain things like earnings or elections or anything going on. So if you have your funds kind of split up between different managers, then you kind of hedging your bets. If one manager made a wrong move and one of them may do something that's more favorable. So all things created equal, I definitely want to put this point across that the funders are only as good as the managers. They're only as good as the managers. This is not like you're holding, like let's say you want to compare VOO to SPY. There's two different vehicles to hold the S&P 500, right? But the thing is, right, they're just holding it, and they're probably, they have a little difference of expense ratio. Maybe SPY is a little better if you want to trade options on it. But for the most part, you're kind of splitting hairs because the total return will probably be very similar, maybe off by a percent or a fraction of a percent, because they hold the same underlying. So that's why people don't really pay attention to who the fund managers are. But when it comes to these actively managed funds that are option-based funds, the derivatives, and it's all about risk management and how they manage these funds, it really, really does matter, first and foremost, the fund managers. The fund is only as good as how they manage it, and so that's why if you find two fund managers, I know I sound very repetitive, I like to, maybe if I want to have a certain exposure to a certain underlying and a certain type of strategy, and if I like both managers, it's not a problem to split it up to kind of hedge your bets. So that's something I want to talk about. You'll see there's some funds that are synthetic cover calls and some of them are cover calls. Now, you have to know something very important. Something that cover calls and call credit spreads have in common. So covered calls are basically, if you owned S&P 500, I think I may have pulled up a picture here. Did I put up? Yeah. So if you own the S&P 500, and then you own the S&P 500 and you write cover calls, you will be more favorable if the market goes down. You outperform versus not doing cover calls. Because if the market goes down, yes, you lose. You go down with the market, whether you're running cover calls or not. But you're making this extra income, so you have down lesser the income that you've brought in from the option premium. If the market is neutral and it stays around the same or it chops up and down a little bit, you also will outperform the market. So the stock didn't really make any massive strides, but you have also no massive strides in the actual P&L of the underlier, but you're collecting premium along the way, so hence you are outperforming the market. And cover calls and also call credit spreads you can also play it slightly bullish too. If the market goes up until your short call, right, or the short leg of your call credit spread, you're able to catch some of the upside if you hold the underlying and exposed to the underlying index or whatever underlying it is. So call credit spreads and covered calls will outperform the market on a down market, a neutral market, and a slightly up market up until the point of the cover call. So it's important to understand that strategy. But if a market is just going crazy and running up, you will underperform because the market will do better because you're limited. As you see here in the picture, you're limited by the cap of your strike of your covered call. So there is a limitation. And you could see that so profound with a lot of people complain about Tesla and Tesla. So Tesla is a yield max ETF on Tesla. They do cover calls. Actually, yield max now, well, recently in the past, I think over a month or so, if I'm not mistaken, they also do something called call credit spread. So they're able to capture a little bit more upside, even though they're capped by they're limited by their short call. They could still bring in more. So they have other options now. But I'm saying if you look at the yellow, which is yield max, and Tesla, which is the blue, you see that the underlier dropped together with the Tesla, right? Tesla dropped together with Tesla. People are upset because when Tesla went back up and recovered, you see right here, let's say July 15-ish, somewhere mid-July, you see that the Tesla also came up a little bit, but not to the same magnitude where it was before, because you could see December of 2023, you could see that Tesla was 261, and then in mid-July it was 250. So it was almost back to where it was. And then if you go to December of 2023, you could see that Tesla was at $24. And even though Tesla's was almost back to where it was, Tesla, is not 24. It's like 17. So people are upset, but that's the limitation. That's the name of the game when it comes to the covered call ETFs, that you're limited, you're capped. If there's like a V-shaped recovery, if there's a recovery that's slight, that's gentle, then basically it has time to the option managers are able to slowly, gradually pick up more of the upside. But if there is a quick, you see how quick this went within a matter of weeks. Sometimes they don't have enough time to redo their strikes because they're locked in, and they may not be able to do it. But if there's a gradual momentum recovery, then the cover call ETFs, I would imagine, because that's how when I would do it, they're able to kind of follow along and capture a little bit much more of the upside. But if it's a real rapid one, that's where they're kind of limited. So you have to know what kind of strategy you're getting into going forward, and you have to know what the limitations of the strategies are. And of course, we are talking about purely the price of the underlying. We're not talking about how much premium they got. Maybe the premium may or may have not have made up for the loss, or you have to look into it. But I just want to show you the limitations. So I really strongly believe that even the retail investors that do not know anything about options, they should take as much education as possible about how options work, and maybe even practice with paper money, even practice in a practice account, so you don't have to worry about losing any money, of doing the mechanics of options, of selling cover call, whatever strategy your fund does. I would suggest to just do some paper money. They have these paper money, plain money accounts that you could do that you don't risk any real capital, and learn the mechanics. Get a feel for the price action and the mechanics, and get a feel because there could be a fund that runs an option strategy that you do not agree with. Not every option strategy is good for every single market condition, and not every option strategy is suitable for your personal risk management, what you're comfortable with, whatever makes sense for you in your personal account and the way you manage your account and your allocation. Not everything would make sense. And also, if it's good to know what kind of option strategy you have, because let's say all your funds are doing, let's say, one type of option strategy, but then you may be limited. You may want to hedge it with different types of option strategy. Maybe not. But it's good to know, be hyper aware of what you are investing in. Maybe you don't have to follow every second what their fund is doing. That's why you pay the managers, but you want to know what's going on with your fund. So again, there's raw versus synthetic. Like if they're doing flex options, they may not be, it's cash settled. They may not be share settled versus actual, real stock. in the money, out of the money. Again, you can have, let's say, Rec Shares is known, and like I've mentioned in one of my videos, I think I mentioned it, that they write their covered calls. They write their cover calls average. They mentioned, the fund manager mentioned, about 4.5%, at least at the time that he was speaking, out of the money. So that means that they able to capture some of the upside. That's where Rec Shares are able to do, capture some of the upsides. So yeah, whatever. So the point is that, and then a lot of cover calls or synthetic cover call ETFs, they're literally at the money. So or maybe 0.5% or 0.25% out of the money. So you have minimal upside. Another thing to consider is, are they doing 0 day to expiration? Are they doing weekly, monthly? Are they holding the index, or are they holding individual stocks? So here's a general rule of thumb. So when you deal with an index, it's a basket of stocks, maybe 500 stocks or 100 stocks, or maybe thousands of stocks, so whatever index you're looking at. So indexes tend to have less implied volatility. So there's two things you want to think about: implied volatility, theta decay. And then there's something called expected move and realized move. So these are different things to think about. So the more something is volatile, the more there's a binary event, like there is earnings coming up, or there's an election coming up, or there's some kind of something on the economic calendar happening, a jobs report, inflation report. So when there's a binary event happening, it causes uncertainty. Whenever there's uncertainty, it can cause spikes in volatility, fear, greed. People don't know. It's all mixed. So that tends to produce more premium when you do options. So as an option seller, that means you get more premium. If you do indexes, it's less volatile than running individual stocks. So you have some option-based ETFs that would do individual stocks of the NASDAQ or individual stocks of the S&P 500. They'll choose which ones they want to use. Let's say they use 25 or 50. I know Rec Shares does like a handful of those individual stocks. So you're able to collect more premium because you're running it on individual stocks, which have single stock risk, versus running, some funds are running it on the index. Another thing to consider is, like, let's say, for example, the Roundhill products, they do 0 day to expiration, but on indexes, the S&P 500, the NASDAQ, and the Russell 2000. So when you have 0 day to expiration options, and I have videos, I've done it myself. I've done 0 days on IWM and on QQQ. So when you have 0 day to expiration, even though you have an index, your underlying is an index, which has lower implied volatility, because index tend to be less volatile than an individual stock for the most part. I guess it depends on what individual stock. You're right. So even though it's less implied volatility, but because we're talking about 1 day or 0 day to expiration, the theta decay is so rapid, because the time when you sell premium, you get paid in time. The more time in, the more premium you get. Time is definitely one of the factors. And theta means the acceleration of how much you get paid per time unit. The theta decay is so quick. You get so much premium relative to the time when you're talking about 0 day to expiration. Heck, there is even Tasty Live did some research that even in the same day, if you do an option in the morning, let's say an option that expires today, so it's a 0 day to expiration because it expires the same day you put the trade on. An option you put on in the morning will have significantly more premium than an option you put on in the afternoon. It's so crazy. You don't see that when you're talking about 1 month out. You won't see a big difference in general between the morning and the afternoon, unless something else external happened that may have increased volatility. So you want to think about these options that are 0 day, weekly, or monthly. And also another opportunity with these 0 day or shorter term options is that there's a change in the market. There's a change in sentiment. They're able to pivot. The market's moving quickly in one direction. Because it's 0 day, they can refresh and repivot and reset their positions every single day. Although options that do weekly, monthly have I'm sure they have the possibility. I'm sure if you look at the prospectus, but the 0 day already have it built in that they just reset every single day. And then there's the in the money put option. So in the money put is like the Defiance has 3 in the money puts. They have IWMY, QQQY, WDTE, and these are in the money puts. So just to get to the crux of it, these are very bullish option strategies, and they will outperform if the market would go up and up and up and up and up. If the market is neutral or going down, they may not outperform. They may underperform. So some people I know, they try to do some Defiance and some Roundhill where they get some in the money puts with slightly out of the money calls. So in any market environment, one will favor the other. But of course, if the market goes down, they both would go down, but just to see which one will fare a little bit better in which market environment. And we spoke about the managers already in the beginning. Anyways, I just wanted to put some thoughts out there for you guys, some nuggets to think about. I'm going to keep thinking about other ways of risk management. Again, this is not financial advice. This is my personal journey, my personal opinion. I speak to other investors, and these are things that a lot of us think about. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful rest of your trading day.